Have you ever heard the term, don't put all of your eggs in one basket? As smart investors, it's really important to know how to diversify your investments, otherwise known as asset allocation. In this video, I'm going to be explaining to you what asset allocation is, why you should know about it, and how you can use it to properly grow your investment portfolio. Hey guys, welcome back to my channel. My name is Adrienne. I make videos every Monday on all things investing and personal finance. So if that's something you're interested in, definitely go ahead and hit the subscribe button below. Excuse my different background. I'm actually outside right now. So if you hear any animal noises, it's the birds. Before we cover what asset allocation is, it's important to know what an asset is. So what is an asset? Simply stated, an asset is anything intangible or tangible that can be owned to produce value. It represents a value of ownership that can be converted to cash. Now, there are many types of assets, including real estate, collectibles, private equity, and many others. But for the simplicity of this video, we'll just be focusing on a few major assets that you can invest in. And this includes different types of stocks, bonds, and cash. So now that you know what an asset is, you can now probably guess what asset allocation is. It refers to the mix or combination of assets that you hold. The portfolio with the ideal asset allocation would perfectly balance being aggressive enough to achieve your savings goals while also mitigating unnecessary risks. And balancing each of these is honestly not an easy thing to do, and it changes throughout your life. So you always have to be looking at your portfolio to see if you are balancing these right for whatever stage of life you're in. So why is asset allocation so important? Because your goal in achieving long-term investment growth is to mitigate as much risk as you can. But with investing, there inevitably comes risk, and that risk can be greater or lesser depending on what you're purchasing. For example, investing in the long term in an established company like Google or Apple would probably be a much less risky investment than to invest in a startup company like Theranos, where all of the investors lost around $600 million in this tech startup. Really, no one is smart enough to be able to predict the stock market, not even Warren Buffett and not even a computer program. Warren Buffett is arguably one of the greatest investors alive right now, but especially no one is able to consistently be able to predict the market. And so that means that the best way to invest your money is to diversify your investments broadly. This is not a day trading strategy. This is a buy and hold strategy, meaning that you should only be accessing these funds when there's an actual financial need. So what is the best asset allocation strategy? The best asset allocation strategy involves two questions. One, how much risk are you willing to take on? And two, how long do you have to invest before you absolutely need this money? For example, an investment portfolio at age 25 is going to look much different than someone at 65, simply because of the age difference. At a younger age, you probably aren't going to be retiring for another 30 to 40 years, which means that your assets can be invested more aggressively, and that is to achieve a higher growth, but that also means that you are also investing in a higher risk. Once you get closer to retirement, you have less time for your money to grow, and most of the time you simply just can't take on any additional risk because you can't afford for your investment portfolio to drop 25% in 1 year because you need that money sooner than someone who's 25. So to mitigate the risk, someone at 65 may want to invest more conservatively. These investments may not grow as much, but they are much less risky and more appropriate for someone who is older. However, that is to say that there are some people who are older who have more aggressive investments, and really what I've noticed is the people who have more aggressive investments when they're older, they don't need to access that money. For example, if someone already has a net worth of $5 million in their 60s and they don't need $5 million to live for the rest of their life, they can invest the money that they don't actually need in a more aggressive portfolio because they don't need the access to that money. At the end of the day, you want your portfolio to be balanced so that if some of your investments are going down in value, others are going up in value. I'm actually reading this book called The Solomon Portfolio right now. There was actually a study done that looked back over 6 different kinds of diversification of assets over the past 38 years. And so these assets were large cap US stocks, small cap US stocks, non-US stocks, natural resources and commodities, REITs or real estate investment trusts, trusts, intermediate bonds, and cash. So the portfolios in this study consisted of 1, 2, 3, 4, all the way up to 7 equally weighted asset portfolios, meaning that in a 1 asset portfolio, it consisted 100% of cash, and a 2 asset portfolio consisted of 50% cash and 50% bonds, and a 3 asset portfolio consisted of 33% cash, 33% bonds, and 33% large cap US stocks, and so on. The study found that over the course of 38 years, the portfolio that performed the best was the 7 asset portfolio. And this portfolio consisted equally of large cap US stocks, small cap US stocks, non-US stocks, natural resources and commodities, REITs, bonds, and cash. In the study, every year that one asset did poorly, another one did really well. And I know not everyone who watches my videos is a Christian, but there's actually a verse in the Bible. It's Ecclesiastes 11, 1 through 2, and it says, "Cast your bread upon the waters, for after many days you will find it again. Give portions to 7, yes to 8, for you do not know what disaster may come upon the land." And this is actually said by King Solomon, who is arguably the richest man to ever live. And he was giving a warning to those who were looking to diversify where they're planting their crops. And even though that was thousands and thousands of years ago, the same principle applies today. We even have the study to prove that diversifying your portfolio over 7 different kinds of assets gives a better return than diversifying your investments over any less amount of asset than 7. Even when a financial advisor is just going to diversify your assets to be 60% stocks and 40% bonds, or 40% stocks and 60% bonds, those are all still not very diversified, especially if they're all correlated. Thanks so much for watching my video. If you found it helpful, please go ahead and hit the subscribe button and the like button down below. Comment down below which asset you guys were most intrigued in this video. And with that said, thank you guys for watching, and I will catch you guys next Monday. Bye guys. Why you must be so loud, truck.